Hi, folks, welcome to our podcast. You found the perfect car, filled out the finance paperwork, and waited to get the keys. Then the dealer tells you the lender denied your application. It feels incredibly frustrating and honestly a bit embarrassing. We understand how disheartening that moment is. But a rejected application is not the end of your plans. It is simply mean the lender looked at your financial profile and saw a level of risk they were not comfortable taking right now. It is a strict mathematical decision, not a personal judgment. Today, we will pull back the curtain on the vehicle finance industry. You will learn exactly how lenders evaluate your applications, the main reasons behind the denial, and the clear, actionable steps you can take to get an approval next time. Let us look at how lenders actually evaluate your application. When you submit your details, they enter a highly structured assessment process. Financial institutions use advanced automated underwriting systems to review your data. These computer algorithms work in seconds. They check your credit file, verify your employment details, and compare your expenses against national averages. If your financial profile sits clear within their boundaries, the system approves you automatically. And if your application raises red flag, the process changes. The system might generate an automatic decline or it might divert your file to a human underwriter. An underwriter looks at the broader context of your finances. They examine bank statements and review your employment history to see if a temporary life event caused a financial hiccup. Everything centers on one thing: risk assessment. Lenders want to lend money, but they have a legal obligation to ensure you can comfortably repay the loan. So every lender sets their own internal rules, but the reason for declining an application usually fall into four main categories. Knowing this help you pinpoint exactly where your application fell short. Number 1, credit score issues. Your credit score act as a numerical summary of your borrowing behavior. Lenders rely heavily on this number. Past mistakes like missed payment can stay on your credit file for up to 6 years. If your score sits in the fair or poor category, standard lenders will often deny the request. Number 2, a high debt to income ratio. This is simply how much your monthly earnings go straight out to cover your existing debts. To calculate this, lenders divide your total monthly debt payment by your gross monthly income. If a large percentage of your money is already tied up in credit cards or a mortgage, lenders worry you will struggle to pay for the car. Number 3, insufficient or unsteady income. A consistent, verifiable income proves you have the financial means to make your payments. If you recently change careers or work on a 0 hours contract or are newly self employed, lenders might view your income as unpredictable. Number 4, application errors. Sometimes a denial stems from a simple mistake. If you provide an incorrect previous address or type your salary wrong, the automated system might fail to verify your identity. This triggers fraud prevention alerts and halts the process immediately. When a lender rejects your application, do not immediately apply to three other lenders. A rejected application leaves a mark on your credit file, known as hard search. Multiple hard searches clustered together signal to lenders that you are desperate for credit, which lowers your scores further. Instead, take a step back and follow these practical steps to improve your financial standing. First, check your credit report. You can request this from the credit bureaus such as Experian, Equifax, or TransUnion, or can check from your banking apps. Examine the file for any errors. check that your current address is correct and your date of birth matched with your photo IDs. Next, pay down your existing debt. Focus on clearing a credit card balance or paying off a small personal loan to free up cash and lower your debt to income ratio. Finally, save for a larger deposit. A bigger deposit reduces the total amount you need to borrow. This directly lowers the lender's risk and make it easier for them to say yes. If you take these steps but still face hurdles, remember that Main Street, High Street banks are not your only option. Credit unions offer an excellent alternative. These community focused organizations often look beyond rigid computer algorithms and consider your overall character. You can also explore subprime lenders or consider using a family member as a co-signer or co-applicant to lower the lender's risk. Being denied a car loan is just a temporary setback. By understanding the system, you can fix the weak points in your application and get back in the driving seat. If you find this guide helpful, hit the like button and subscribe to our channel for more straightforward financial advice. We have also linked to our full detailed blog named Denied for a Car Loan. What happens behind the scene? Take control of your finances. We'll see you again in our next video. Thank you.